Hi there, this is Keith Singer of Singer Wealth. Thank you for joining me. I want to talk to you about the importance of downside protection in your portfolio. We don't know what the stock market is going to do on any given day, any given year, or even any given decade. We know over long periods of time it's averaged 7 or 8%. But what you may not realize is that there are always, not always, but frequently 10, 15-year periods where the stock market has negative real returns. And there's periods where it does phenomenally well. And so the question is, what's the next 10 years going to provide for us? Do we have any idea? We do know that normally, if you look back in history, when we have really good prolonged periods, they're usually followed by bad prolonged periods. And when we have really bad prolonged periods, they're usually followed by very good prolonged periods. So we're just coming off a 12-year run, which is really, really exceptional. And if you're in or near retirement, you probably want to consider, how do we reduce the volatility in your portfolio? How do we reduce the risk? What if we get a bad 10 years? How would that impact you? Well, more sophisticated investors use hedging strategies to provide some downside protection. Institutions, family offices, pension funds, they buy put options. They use derivatives, which is really like buying insurance on your portfolio. If the portfolio is down, the derivatives go up in value and they offset the losses, or at least partially offset the losses. Now, obviously, the more insurance you buy, the more that reduces your returns each year, right? So if you're not paying for insurance, you have full downside risk and full upside. If you're paying for some puts and some insurance, then you have limited downside and a little less or a lot less upside, depending on how much insurance that you buy and how much protection you get. Now, a lot of people aren't aware of this, but there are products available that actually provide downside hedging against the stock market going down, and you don't have to be a genius to create them yourself. You can just participate in certain funds or products that are available that limit your downside. Now, I want to talk about the importance of downside protection, especially for people that are in or near retirement. So I'm going to share my screen with you. And we are going to go through a little PowerPoint. I'm going to start this slide from the beginning. So if you look at the S&P 500, from 2000 to 2020, if you put $1 million in, it grew to 3.83 million. Now you'll notice there were 4 bad years, only 4 negative years, and 3 of them occurred in the first 3 years. And if you look, even though your million grew to 3.8 million, after 10 years, we had a bad decade, you only had 908,000. After 9 years, you only had 718,000. So from 2000 to 2009, you lost about 40% of real value, right, when you account for inflation. And then what happened was, at the time when everyone was getting nervous and getting out of the stock market started doing well, and you went from 718,000 to 3.8 million in 13 short years. Now, 1 more year later, with the aid of federal stimulus and a very accommodative Federal Reserve, your million now grew to 4.93 million in the S&P 500. Now, what if you were using hedging strategies, right? And you used a lot of hedging strategies so that you had no downside risk, but your upside was limited to 9.25%, right? Because that's the cost of the options. It's limiting your upside. And so now you have, after 10 years, your million's $1.5 million versus 908,000 for the S&P 500. But after 21 years, your million's only 3.6 million versus 4.9 million for the S&P 500. Now, what if you used a little bit less hedging strategies, a little less expensive, and you only had 10% downside protection, right? So if the market's down 15, you lose 10. If it's down 20, you lose 10. If it's down 8, you lose nothing. So now you have 17% limits on how much you can make, right? So your range of return is more wide. You have a little less downside protection and more upside. And so if you look in the bad 10 years, your million's $1.2 million versus 900,000 for the S&P. But it's almost what the S&P did after 21 years. It's 4.7 million versus 4.9 for the S&P and 3.6 million for the full downside protection. But remember what happened in the first half of 2022. We lost 20%. So if you go through the end of June of 2022, your million is now down to 3.9 million. It still remains 3.6 with the full downside protection, and it's 4.2 million for limited downside protection. So in some scenarios, having downside protection will actually help you make more money than having no downside protection because you're eliminating really bad years. Now, what's very interesting is what if you're in retirement and you need money, right? You've accumulated all this money, and 20 years ago, let's say you had $1 million in 2000, which was a lot of money back then to retire with, not so much today. And so you are taking out 60,000 a year, and you're figuring you're going to be safe because you know that the stock market average is 8, and you're only taking out 60,000. But what happens is if you realize that in the early years you had some bad years, you had some very bad luck with your sequence of returns, right? Because you had bad years were early, and you're taking money out every year. And so what happens is that starts an irreversible process of you running out of money, and eventually you run out of money by the year 2017, okay, after 17 years. Now, if you took the same 60,000 out of the full downside protection account, the full hedging, and you're taking 60,000 out a year, but in the down years you didn't lose, then after 20 years you still have 705,000 versus being run out of money, right? And if you had limited hedging and more upside, you still made it out better because after 20 years you still had 572,000 versus having no money in the regular S&P 500 and 710,000. So the moral of the story is, if you're young and you're adding to your pile, you really don't have sequence of return risk, and it's not as important to reduce your volatility. You can be aggressive. But if you need to be taking money out of your account, or you just don't want the risk anymore, you don't want the uncertainty of what a bad 10 years in the stock market could do to your portfolio, you just want to know that you can live the way you want to live, then having less volatility in your portfolio, either through diversification or through hedging strategies, can really, really help you sleep well at night and get you better results in the event we get a bad stock market for 10 or 15 years. And so it gives you more hedging, and downside protection gives you more predictability, more dry powder if you ever want to get aggressive once the market goes down and try to take advantage of market corrections. And again, no sequence of return risk. If you can eliminate downside returns, if you eliminate negative years, you don't really have a significant sequence of return risk. So if you want to learn about how to hedge your portfolio, what strategies are available, give us a call at 866-WEALTHY, or simply return this email if you're seeing this by email, or again, call us at our local number is 954-462-3300, or send us an email to keith@singerwealth.com. Thanks for listening, and we'll talk to you later.